Hello, you're welcome to today's training. How to trade and identify the best risk to reward setup. Okay, if you don't have an account with FTX, I urge you to go ahead and do that now. There is a link below you could register, and we want you to do that now. Don't worry, we will wait. So for those of you who don't know me, my name is Gilbert Juekbata, and I'm the founder of Smart Investors Lodge. We are dedicated to help you create a source of income and build wealth with the cryptocurrency market. When I got into the cryptocurrency market, I started out as an investor, which I was introduced to value investing strategy as a teenage boy. So when I got into cryptocurrency, I decided I was going to stick as an investor. I never thought I will become a trader, but I now decided to venture into trading, and I was very fascinated with trading, meaning I could always go in and out of the market at short term and come out with profit. So once I started trading, I discovered I need technical know-how, which means I need to understand technical analysis more. So once I started gaining mastery in technical analysis and I was trading and also making profit, I discovered technical analysis anyway was not the holy grail. And I decided to uh, pay more attention to risk management, and I was glad I did, because doesn't risk management actually keeps you in the game, helps you identify potential risks and guide yourself accordingly. So I found this area of risk management, which is called risk to reward ratio, which once I was able to understand and master it, accelerated my trading game. So if you pay attention to the end of this class, you are going to gain value. I assure you it's going to be worth every bit of your time. So let's look at what you will learn. So at the end of this training, you will learn how risk to reward works, how to identify risk to reward ratio. You also learn how to identify your risk to reward using ftx.com. You will also learn how to increase your winning rate, how to trade the best risk to reward ratio as well. Alright, so I really love this, how to identify your risk to reward using ftx.com. I love this because most persons may tell me the process of identifying risk to reward this manually maybe a little bit tedious, complex. So if you think you're not maybe book smart enough and you're more of the street smart guys, that FTX got you covered. So FTX has a tool that can actually help you calculate your risk to reward if you know how to use it. So stick with me, we are going to get there. So let's look at how risk to reward works. First of all, let's understand what is risk. Risk. This is the potential loss which occurs when the market moves against your anticipated outcome, leading to losses. So I really like this word, potential. So this is the potential loss. You want to find the potential loss. You want to find your losses before they become losses, so you can guide yourself accordingly. So once the market moves against your anticipated outcome, it leads to losses, which becomes your risk, while reward This is your potential profit gain when a trade moves in a trader's anticipated projection. So when a trade goes the way you plan, the profit which you make becomes your reward. So one thing you must always know is you have to treat trading as a business. Every business always has its risks. Business also comes with losses. Once you are able to identify each risk in a given trade compared with the reward, you will be able to know if it is always worth you taking each trade. So traders use risk to reward ratio to identify an expected gains for every dollar risked in the market. So risk to reward differs among traders depending on their strategy or predetermined risk to reward ratio. Example, we have 1:2 risk to reward, we have 1:3 risk to reward, and we also have 1:5 risk to reward. Let me step this down, so if there is a trader who is watching this who is not familiar with risk to reward ratio, you will be able to learn and catch up with us. So when we mean 1:2 risk to reward, we mean for every $1 you take into the market, you're coming out with $2. For a $1 you take to the market, you will come out with $3. For $1 you will come out with $5. So this is what we mean by 1:5. All right, let's move further on how to identify and trade risk to reward. I'm going to show you how to identify and trade risk to reward in 3 simple steps. But before further ado, to determine your risk to reward, you need an entry, a take profit, and a stop. Let me walk you now through these 3 simple steps. 1, you need to identify your entry. Before, when you go into the market, there is always the point where you buy. Once you find out the point you buy, you need to identify the distance of your stop loss, the point which your stop loss is going to trigger, which is your risk. The third thing you need to do is identify the distance of your target profit. I found 2 popular traders were arguing in the comment section in their Facebook feed. One was arguing that there is actually nothing like risk to reward, actually saying that he trades and he does not really use anything called risk to reward, because he actually knows where he's going to buy and he knows where, if the market gets to, he's going to sell. And though I did not engage in their discussion, but what he's saying is like now like an old man in the village who is saying that surveying a land does not work, and that he does not need to survey his land because he knows where his land starts and where his land ends. So whether you know where your land starts and where your land ends, it means you have a mental risk to reward. Now, this does not mean if you're selling your land to me, if I now have to go buy this land from this old man in the village, I will not survey the land. So him having a mental survey and me making it or putting it on paper makes no difference. It's just that writing down your risk to reward makes it better for you, because it gets written down into your subconscious mind. Just like I could say it's not just about having a mental survey of your land. It's better you survey the land and have it written down on paper. So the distance between your entry to stop loss is your risk, while the distance of your entry to the target profit is your reward. Let me take this again. The distance between your entry to stop is your risk, while the distance of your entry to target profit is your reward. Let me give you example. If your stop loss is $1 and your projected target is $3, this means our risk to reward ratio is 1:3. Okay, let me say this in another way. To get your risk to reward, you need to calculate the amount you stand to lose if the market goes against you and the amount you stand to gain if it goes your way. So let's look at how to identify your risk to reward using the FTX exchanger. Alright, it's simple. Once you go to the FTX exchanger and you're in the chart, you pick the prediction and measurement tool by the left, then draw to identify your entry, your stop loss, and the target profit. Once you do this tool gives you all the analysis you will need. This is going to be a practical session, so stick with me while I make this very worth every bit of your time. Okay, looking at this chart, we have the BTC USDT chart. So what we want to do is identify our risks. So if you look, the market fell off from this point, it got broken, and we had to test this old support. And looking at this, the support is holding, and I think there is a consolidation is taking place. The next thing that will happen as long as this support holds is we are going to move to the upside. So you could see I have this arrow here. Let me tell you why I did this. I had to measure the distance of this fall. Do you see? So that is why I got this. Why did I do that? You know, the market always tends to repeat what it has done over a period of time. This is our potential reward as long as this support holds. So how can we identify our potential risks once this support gets broken? Once this support gets broken, we are going to test this zone, the 9,000 zone. Most persons will always ask, where do you put your stop? And there are some given percentage to which you should use as your stop. But as much as this sounds very nice theoretically or on paper, practically you always put your stop below the market structure, and most time we always tend to widen our stop because by experience you could see where you are in a trade and the market will hit your stop and reverse back immediately. So we don't always tend to use tight stop except we are in a trending market, so we could decide to use tight stop. So let's go back to business. How can you find your risk to reward using the tool I told you on the FTX platform? Okay, you see where I am. You just click on it. This is the measurement tool. So you're going to pick the long position and draw. You're going to draw from your point of entry. let me squeeze this in so we could see better. Why are you disturbing me? Alright guys, I have to squeeze that in and then we'll draw. So I want to draw our potential profits to get to our target. So our stop, you can adjust. Okay, I need to bring this down so we could be accurate. Okay, so let's look at this. We have our entry. Somebody may tell me my stop is too wild. Okay, so it's all up to you to draw. Do you notice while I drag the each point to which I drag, readings happen? So looking at this chart, our target is, we have over 20%, 20.96%. We also have a stop in percent and how much we stand to lose if our stop hits, and how much we stand to gain if our if our reward hits as well. It gives you everything you need. So the chart does all this for you. Okay, doing this is to make it practical for you to see how it works. You need to determine how tight or how wide you want your stop to be. So this is for the purpose of illustration. Can I show you this again, how it's done? Come to this tool, which is the measurement tool. You pick long position. That was what I did. Once you pick long position, you draw from the point of your entry to your target, and also adjust to where your stop is going to hit for it to trigger, and you're going to get all the information you need. All right, let's move over. Okay, so I hope you got value from that. The most important aspect of this training, if you got all I just taught, because if you don't get me from the beginning, you may have issues understanding me now. But if you understood me from the beginning, at this point I think I'm going to take you from the level of your understanding to the next level, how to increase your winning rate. Risk to reward is not the bigger picture of trading this setup. When we go further, I'm going to explain further why I say so, and you're going to see things for yourself. Okay, so I'm going to explain, giving you a comparison. So now, I'm going to give you a risk to reward of 1:2 and 1:3 on a $100 trading account. So two traders, one is going to take the 1:2 risk to reward ratio, the second trader is going to take the 1:3 risk to reward ratio, and we are going to take 5 positions. So you could see the both took the first position together, the both of them lost. The second position, the both of them lost. Likewise, the third position. So you see the fourth was a win, the fifth was a win. At the end of the day, the first trader with the 1:2 risk to reward ratio is at loss, while the second trader with the 1:3 risk to reward ratio won. So now I'm going to ask you a question. Is the secret in a higher risk to reward ratio? So Paul Tudor Jones, who Tony Robbins considered as the greatest trader alive, actually uses 1:5 risk to reward ratio, which means for every $1 he takes to the market, he comes back with $5. So if this is the case, why shouldn't you use 1:1000 risk to reward ratio or 1:2000 risk to reward ratio? This is because of probability of outcome or winning rate. Don't forget, we are in the topic how to increase your winning rate. So understanding this takes me to what I call the art and science of outcome. The art and science of outcome comes with what I call the probability of outcome, the risk to reward ratio, and cost of time. But before further ado, I am going to leave you with the words of George Soros. He says, it's not whether you're right or wrong that's important, but how much money you make when you're right and how much money you lose when you are wrong. Let's look into the probability of outcome. The probability of outcome is also known as winning rate. This is the mathematical process that will save you over a long run. So if you have $5, let me ask you a question. If you have $5 with a proposed 5 position, with a probability of losing 4 of those trades and only winning 1, will it be worth taking the trade? Let me know. Will it be worth taking such trade? I assure you, you should take every one of those trades, because at your last trade, you're going to come back 5x bigger and better. The probability of outcome is always multiplied by your risk to reward ratio. Your risk to reward ratio is how much you lose or make. Your position size, you're free to write this down. Your risk to reward ratio is how much you lose or make. Your position size, don't forget, the smaller the size, the bigger your potential profit, which is always multiplied by your cost of time. Your cost of time is how long it will take you to get your desired results. So if you get the risk to reward ratio of 1:2 in 2 years, will it be worth your time? Will it be worth taking such trade of 1:2 in 2 years? I guess your answer is no. Why? Because you're going to tie down your accounts. You're going to tie down your money for the next 2 years, and it's coming with a very little reward for such time. And that is money you would have spent on other trades, which would have given you way better profit. So this is why, as traders, we always look at volatility in lower time frame, because all of this, your probability of outcome, your risk to reward ratio, and your cost of time equals profitable trading. So it's not whether you're right or wrong that is important, but how much money you make when you're right and how much you lose when you're wrong, like George Soros will say. So your probability of outcome, your risk to reward ratio, your cost of time helps you determine your risk, which is how much you're going to lose when you're wrong, and your reward, which is how much you're going to make when you are right. So let's now look at how to trade the best risk to reward setup. 1. Trade market structures. Always trade the market structure. You want to buy at support and you want to be selling at resistance. Can I take that all over again? Or you understand me? Okay. Trade market structures. You want to be able to identify what is going on in the market and always buy at support area or be and be selling at resistance area. You don't want to be buying at resistance, right? The next thing you want to always get the best risk to reward setup is trade the trend. In an uptrend, you want to be buying. In a downtrend, you want to be selling, not the other way around. If you put this in place, you will be able to get the best risk to reward setup, which is going to fine tune your trade and help you get the best results in the marketplace. All right. Thank you.